This is Scott Becker with the Becker Private Equity and Business Podcast. We're joined today by Matt Wolf, brilliant leader at RSM. Matt's going to talk to us. Really, we're going to touch on three subjects today: sort of interest rates and CPI. Second, the private credit and lending environment. And third, some of the trends we're seeing in different types of healthcare transactions, whether pharma, life sciences, or provider transactions. Matt, let me tee it up and ask you to take us away. Thank you for joining us.
Yeah, thanks for having me on, Scott. Happy to. Earlier this morning we had a sort of encouraging, I would say, CPI print that confirmed, what a lot of market observers, RSM included, have been saying, that we have been seeing kind of a consistent, sustained deceleration in inflation. With the release of that news, the market is now pricing in about a 90% chance of a September rate cut, which has been our call for a while. JP Morgan even came out and they said, hey, we think that they had been thinking that the first rate cut would be November. They're now saying September as well. So that's encouraging there. I think the big story, or one of the big stories from the CPI print, has been on shelter inflation, which saw again another month of consistent declines, which has been really interesting. Analyzing some of that data now with the advent of more real-time sort of rent indication data points. And we've seen that, like I said another way, this has really been unsurprising to anybody who's looked at some of the real-time leading information on the rent component of CPI, which is a big component of CPI, of course. So no surprise to see shelter and rent sort of decelerate again, continued for, I think, over a year now. It's gone down, which has really helped bolster this story that we can expect to see sustained deceleration of inflation, not necessarily disinflation again, but a slowdown in the rate of change of inflation that, based on pretty much, or what most of the Fed governors have said, the FOMC voting members have said, should support coming rate cuts, likely as early as September. Probably not going to see one this month, in July, and then after September, probably another 100 basis points throughout the rest of the year and into 2025, which is encouraging. The other note on the rate cut environment that we think will happen is we've gone from an inverted yield curve to a fairly flat yield curve, and we think that this movement will continue to put pressure, downward yield pressure on the lower end of the curve. And so hopefully that will also encourage some more risk-taking appetite and risk-on investing behavior as the yield curve sort of continues to normalize.
No. I think you hit it very well. Inflation's slowing a little bit. Some hopes for rate cuts as much as 100 basis points over the next 6 to 12 months or so. That would be a lot. We'll see how that goes. And then tell us about what you're seeing in the private credit environment.
Yeah, so happy to. I mean, this is, on the rate cut side, this is what everybody's been waiting for, right? Is let's see the return of the deal flow. But what's interesting on the other side of that is, PitchBook has come out with some really interesting data that shows and suggests that the larger private credit firms and funds have really been able to attract the lion's share of new investing dollars. And the smaller funds that are more focused on the lower end of the middle market have really struggled over the past 6 to 12 months to continue to raise funds and to continue to kind of operate in that way. And part of that is it's just hard to scale down there at that level of deal size and still present a competitive fee structure to limited partners. And so we might see, and one thing I'm kind of concerned about and I'm trying to watch and monitor is, what does that do for liquidity at the lower end of the middle market if especially the larger LPs are less interested in allocating some of their dollars to smaller middle market, lower middle market private credit funds? What does that do to companies down there who really definitely need that money? So I'm curious what that will look like going forward. We need to see an uptick there. Even overall, we're still kind of down from prior years in terms of overall private credit fundraising, especially on the lower middle market side. But the interesting part there, Scott, is, there's a whole bevy of academic and investment research that suggests, these lower middle market private deals, private credit, private debt instruments, they do generate a return above sort of higher middle market debt, right? So there has to be a space in the market for funds that can demonstrate an outsized return in the lower middle market space, and consequently also command something of a management fee premium just to keep the doors open, right? Because it's more expensive to operate down there, and can attract those LP dollars. So
I think it's a fascinating discussion. It strikes me that in a high rate environment where there's often more fragility on the smaller size companies, that business becomes more challenging to create the delta you want to create. Because if people can get relatively high rates with mid-sized companies, it becomes harder to get super high rates without making those smaller companies very fragile. And we've seen a lot of it over the last year as different companies have ended up with, a whole bevy of companies have ended up with covenant defaults, if not actual payment defaults on loans and credits and stuff like that. So I see that as a fascinating area, sort of the lower middle market, private credit. And as the yield curve comes down, maybe a little bit more profit in that for the private credit firms.
yeah, and I think the way that a lot of capital allocators look at their investments, and I know I've had conversations with many of them, is like, okay, well, it takes my team X hours to work on a deal, or X number of weeks to work on a deal. Well, why not just do the $100 million deal then instead of the $20 million deal, right? All else equal, time investment equal. Let's do the bigger deal. We're going to get higher cash returns, and that's maybe part of the analysis too. But when it comes to looking at these returns, we always have to think about sort of a risk adjusted basis, right? What is our dollar return per sort of unit of risk, however we want to measure that? And when I think of the lower middle market, like, yes, a massive optimization of their operations might increase EBITDA from $5 million to $6 million, which on paper, like, okay, that's not, yeah, $1 million is real money. It's not anything maybe to get terribly excited about in the middle market space. However, a lot of these smaller companies making that improvement is actually a less risky endeavor than in some of these larger, complex middle market companies that have a lot of different business units, and they have a lot of other multiple product lines. They have all these things going on. Like, it can be much more difficult to get a 20% increase in EBITDA if you go upstream than it can be for some of these smaller companies. Not necessarily, it's not always true, but that can be true. And so as we're kind of evaluating these deals and evaluating these companies, it's always important to understand, well, what is the sort of expected return per sort of risk adjusted dollar that we're looking to allocate here, whether we're investors, whether we're, sponsors, whether we're advisors, whatever we're looking at. We always got to look at everything on a risk adjusted basis like that.
100%. No, it's a fascinating perspective. What a fascinating situation. I'm going to talk to you for a moment about deals in the healthcare and life sciences area, and the take that we've seen out there recently, or seen people commenting on, sort of provider practice transactions. I'll go through 5 areas very quickly. Relatively slow. Medical device transactions moving along well. Biotech, pharma, quite busy, quite frankly, busy. That's been in years. Revenue cycle deals, medium busy is what I'm told by people. And then sort of health IT, data. There's discussion in PE Hub about this area being a hot area. I don't see it yet, but maybe moving in that direction. What's your take? Any quick takes on the 5 areas we just mentioned?
Yeah, I think in general, we're seeing a realignment of investment thesis where we have more sponsors that are taking a hard look at saying, okay, do we want to be in healthcare? Do we want to invest in companies that have direct CMS or commercial payer reimbursement risk? Yes or no? And more of those sponsors are saying, no, we no longer want to do that. We're going to move into revenue cycle. We're going to move into healthcare IT. They haven't closed many deals there yet, but they want to focus on those areas. They like the healthcare space, but they do not want direct reimbursement risk. And we're seeing a similar story, although maybe not as pronounced on the life sciences side, where certain sponsors are saying, okay, we really like this space, but maybe we're going to tone down the number of molecules that we invest in. We really like what's going on with sort of AI tools and clinical research, contract manufacturing, data analytics around the space. And that's been hot for a while, of course, but there's certainly new applications coming out every day for using data, using artificial intelligence and the sort of the life sciences side. And we're seeing some sponsors focus more on that, not necessarily abandoning investment in therapies, therapeutics, devices, molecules wholesale, like some sponsors are on the healthcare services side with direct reimbursement, but sort of getting into more of the peripheries. I would say that's a trend across healthcare, more pronounced on the services side, less pronounced in life sciences, but we definitely are seeing that. And the lag right now, everybody's talking about it, nobody's quite doing it yet. That's partially a function of just the extended due diligence timelines that we're all living in now, right? Like sponsors are taking their time doing due diligence now compared to the sort of rapid cycle that we saw even just 2 years ago.
But that's a fascinating perspective. And for those with the history in this, like you have and I have, this reminds you of 10 years ago when we used to talk about not being in the provider world, but being in the provider light world, where you're doing services related to providers versus providers directly. I mean, it's sort of a fascinating retake on something that was a very, very clear situation just not that many years ago, where people were going to be either in provider or provider light businesses, which were provider light meant things that were doing services providers and more, but not actually providers. And so interesting to see that return to that type of mindset. Absolutely fascinating. Anything else you wanted to add to that?
Yeah, I mean, I was just going to say that, 10, 15 years ago, as you were alluding to, people were scared of investing in businesses that would take reimbursement until sort of realized that, well, money is so cheap, we can bundle these together. And as long as we have good advisors that'll keep us on the right side of the corporate practice and medicine laws, we can sort of bundle together some providers and exit to a larger private equity firm or somebody else and make a decent return, right? There was a business in that, but now as rates are higher and we need to make operational improvements, investments to generate that exit value that'll sort of pay for our 2 and 20. That's now what's driving a lot of these sponsors to reevaluate those investment thesis.
Matt, thank you very much. Always great to visit with you again. Matt Wolf on the Becker Private Equity Business Podcast. Matt Wolf of RSM, brilliant leader. Thank you for joining us today.
Thank you, Scott.